The Government of India's decision to privatize IDBI Bank has sparked a wave of protests and resistance from banking employees, civil society organizations, and prominent economists. At the heart of the debate lies a crucial question: should a key development financial institution, DFI, with a legacy deeply tied to India's industrial progress, be handed over to private hands? Development financial institutions are not ordinary commercial banks. These are specialized entities created to provide long-term capital to sectors vital for national development, such as infrastructure, heavy industries, manufacturing, and green energy. Unlike commercial banks focused on short-term profitability, DFIs are built to serve public interest, mitigate market failures, and support projects with long gestation periods that private investors often avoid. IDBI was established in 1964 as a subsidiary of the Reserve Bank of India. IDBI played a pivotal role in building the backbone of Indian industry. It funded key sectors including steel, heavy engineering, and public infrastructure. More importantly, IDBI was instrumental in establishing foundational institutions like SEBI, Securities and Exchange Board of India, NSE, National Stock Exchange, and CDBI, Small Industries Development Bank of India. According to noted economist Professor Venkatesh Athreya, IDBI was originally designed for long-term, low-interest lending, a deliberate strategy to foster national development. The conversion into a commercial bank already weakened that vision. Privatizing it would only push it further away from public service. Professor Athreya further explains that development banking requires a different mindset and skill set. Development finance inherently includes an element of subsidy, meant to support strategic sectors or long-term projects. When privatized, the focus inevitably shifts to profit maximization, leaving behind critical sectors that may not yield immediate financial returns. Across the world, leading economies maintain publicly owned DFIs to ensure alignment with long-term national priorities. In Germany, KfW and DEG support public and private development projects with strong government backing. In the Netherlands, FMO is 51% government-owned and focuses on high-risk, development-centric investments in developing nations. The UK's British Business Bank supports small business access to finance. Scandinavian DFIs, like Swedfund and Norfund, invest in socially responsible projects. Japan's JBIC supports infrastructure and strategic partnerships globally, while the US International Development Finance Corporation promotes development aligned with American strategic interests. The common thread across these examples is clear. Public ownership ensures accountability, transparency, and alignment with national development goals. Professor Athreya points out that India's neoliberal reforms post-1991 weakened development banking. Privatizing IDBI continues that trend. Once in private or foreign hands, the government loses its say in how national resources are channeled. A report by Eurodad highlights that private DFIs tend to be less transparent and less aligned with national goals. Unlike state-run DFIs, private players are unlikely to engage in counter-cyclical lending during economic downturns, a critical need in emerging economies like India. The consequences of privatizing IDBI Bank are significant. The institution, once a cornerstone of India's industrial policy, may no longer fund sectors that are vital but not immediately profitable. Infrastructure, renewable energy, and manufacturing all require a kind of long-term commitment. It can be ensured by only a public DFI. India still needs development banking. Many entrepreneurs and sectors require patient capital, something private investors are not keen to provide. While the government argues that privatization will bring efficiency, critics stress that efficiency cannot replace developmental intent. You are handing over public assets built with taxpayer money. The profits go to private entities, while the state loses its ability to steer growth. The proposed privatization IDBI Bank is no longer just a business decision. It's a debate about the country's vision for inclusive growth, economic resilience, and social responsibility. As protests mount and experts raise serious concerns, the fate of IDBI Bank has come to represent more than just one institution. It stands at the crossroads of India's developmental future. This is a test of our national priorities. Will public finance continue to drive inclusive growth, or will vital institutions be reduced to tools of private gain? The outcome will shape how India builds infrastructure, supports innovation, and empowers millions still outside the economic mainstream. In deciding IDBI's future, the nation is defining the direction of its long-term development path.